Hello and welcome back. Well, some market players have once again been poised on the edge of their seats, hoping to get a glimpse of something new from Federal Reserve Chief Ben Bernanke in his testimony today. Alas, this hasn't really been the case. On the line with me now from Toronto in Canada is Sal Guatieri, the Senior Economist at BMO Capital Markets. Sal, thanks for joining me today. So talk us through the testimony if you could briefly. This was pretty much what the markets expected, wasn't it?
For the most part, yeah. He struck a somewhat more dovish chord than I think many anticipated, though, to the extent that he just doesn't believe the economy or labor markets have improved enough to certainly end the stimulus, if not even slow the rate of stimulus or asset purchases. So I think it was a little more dovish than some people anticipated, especially in light of recent comments from other Fed officials who seemed a little more eager to at least slow the rate of asset purchases in coming months once they saw a little more progress in the economy. Bernanke is essentially saying that, yes, once we do see that progress in the labor markets with the unemployment rate falling further, job growth picking up, then we will eventually end the stimulus. But he's not giving any guidelines as to the timing, certainly not this summer, perhaps not even into the fall. And I think that's a bit of a surprise to the markets.
Now, what about this idea that there's a problem with markets reacting faster than the Fed would like?
Well, he always runs that risk, and maybe that his comments are a little more guarded because he doesn't want to sound, I guess, more hawkish than he intends to sound, because that could unsettle the debt markets and perhaps even the equity markets. So maybe there's a bias towards sounding a little more dovish than than his true feelings are. But it's pretty clear in his statement that he's just not ready to even slow the rate of asset purchases until he sees much more progress in the labor markets. And that likely means the unemployment rate falling further and the rate of job growth picking up.
What about unemployment? Numbers are still very high in the US. This must still be worrying Fed officials.
Well, it is, in particular Bernanke, because he's very concerned that the elevated rates of unemployment will undermine the economy's longer-term growth rate. People lose skills, they become less employable, and productivity can actually decline. So he's very worried about that. He's also very worried about the high level of underemployment. He continues to refer to the fact there's still a lot of people working part-time who want to work full-time hours. So he's very worried not just about high unemployment, but the high level of underemployment. So he obviously believes there's still a lot of room for the economy to grow, for the unemployment rate to fall further before he needs to worry about inflation. And right now his main concern is that inflation is too low and risks actually deflation, that prices could actually fall, and that could cause problems for the economy. So as a result, both because of elevated unemployment and too low inflation, he's just not ready to even slow the rate of asset purchases.
Okay, so how does Mr. Bernanke exit from all this? I mean, he says QE3 purchases depend on data. Nothing particularly new there. Some are saying QE has run its course. How does he go forward from here?
Well, the first step would be to actually step back on the monetary accelerator, slow the rate of purchases of treasury bonds and mortgage bonds. And that would start to put upward pressure on longer-term interest rates, both because the Fed is not buying as many of those instruments and because the market will start anticipating eventual tightening. But again, the first step is the Fed to ease at a slower rate than it has been. And eventually, probably when we get, but perhaps not into 2015, until we actually see full-scale tightening where the Fed will start lifting short-term interest rates, possibly at an even later date, selling some of the assets, its treasuries and its mortgage bonds. But you're not talking about tightening for at least another couple of years. The first step is just to slow the rate of easing it. It eventually just stop easing further. Right now, though, the chairman is not just worried that unemployment is still too high, inflation is too low. He's also worried that the economy has hit a soft patch, largely because the government is cutting spending, so-called sequestration. And he's not entirely convinced that the soft patch is just temporary. He thinks it is, but he wants to see clear evidence in the data that the economy is picking up before he slows the rate of asset purchases.
Okay, that's all for now on that all-important testimony from Fed Chief Ben Bernanke. Analysts pretty much saw this coming, and so did the markets. Not the first time either. I'll see you tomorrow for the press review. Goodbye.